Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management, and we're certainly happy that everyone could join us today. It's been another volatile week, to say the least, but at least what we're seeing is more upside volatility than downward volatility. So we want to focus on this week is, what does it really mean for the market and your portfolio now that the Federal Reserve has officially crystallized higher interest rates? Now, the lead up to that event was certainly one of fear and uncertainty. But one of the things that we've been coaching clients and advisors on really here over the last few months is that higher rates have already happened. We've already seen about 7 interest rate increases into the real economy. We just have to look at what mortgage rates are doing, or car loan rates, or credit card rates. It's already happening in the real economy, which is why we saw that volatility in asset prices. So now that the Fed has actually started the process of raising rates, the market can now move to what is going to happen after the so-called 6 to 7 rate hikes. In other words, what will January of 2023 look like from a Federal Reserve policy standpoint? And does that really start to happen not in January of 2023, but in June of this year? So we're going to go through all of that today. And what we're calling this week's presentation is, are we at peak rates? And what we mean by that is, we know that the Federal Reserve officially raised rates, but what did they actually say? So what did the Fed say, and what does it mean? And is the economy actually slowing or accelerating into these higher rates? And then lastly, we're going to look at, how does the slope of the recovery impact asset allocation? And that's perhaps the most important question, because that's what actually affects and impacts your portfolio. Now, to recap the Federal Reserve meeting, the Fed raised interest rates by 0.25%. So we're now sitting in a band of 0.25 to 0.5%. Let's take a step back and look at where policy rates are. They are very easy. Money remains very cheap from a policy standpoint. Second, the Fed dot plot. So in English, the Fed dot plot is just a survey of all the members of the Federal Reserve board, those who can vote on policy. And what they are expecting right now is 6 to 7 rate hikes. Now, will that actually happen? No one knows, right? It really kind of depends on what the economy does going forward. If we looked at the Fed dot plot last summer, no one expected any rate hikes for about 2 years. So you have to take the Fed dot plot with a grain of salt and pay attention to the data, and then allocate assets as such. And then the third message from the Federal Reserve was that they see demand strong enough to withstand rate hikes. Now, we're going to counter that argument today and go back to how that impacts how we trade and how we allocate assets. But I want to emphasize that we've already seen 7 rate hikes. If we look at the 2-year interest rate, it's sitting right around 1.9%. And that tends to be most correlated with the Federal Reserve rate. So you got the Federal Reserve rate at 0.25 to 0.5, and a 2-year rate at 1.9, and a 10-year rate sitting at just around 2.2%, a little bit under, about 2.15%. Why is that important? That impacts real money. Mortgage rates have gone from 2.8 to 4.2. So if you're out there getting a mortgage, that's more dollars out of your pocket, because the market has already priced in 7 rate hikes. Same thing for a car loan. Same thing on credit card rates. Those rates haven't priced in 1 rate hike, and then we'll price in another one a month from now. They've already priced in 7. So for us, when we're thinking of Federal Reserve policy going forward, we're looking at starting at 7 rate hikes, and where does policy go after that? And do we even get to 7 in actual policy? So what do we know? Because remember, the Federal Reserve is not a soothsayer. They don't have information that we don't have, or that you don't have, or that anyone doesn't have. They look at the same data we all look at. So what do we know? We know that economic growth is slowing, not accelerating. And that's really key. Retail sales are slowing. We saw that this week. In fact, negative in some cases when we strip out the impact of gas sales. So consumption is also shifting from goods to services. When you shift consumption from goods to services, that inflationary impact starts to decrease. Number two, inventories have grown massively, and we're going to go through the chart on that. That becomes a drag on future growth. And the other point that we did not mention on here was that a lot of the stimulus dollars over the last couple of years because of COVID are now expiring. So that's going to actually be a net drag on growth as well. The other thing we know is that inflation is beginning to slow. Wage growth has flattened out, 0.0% reading last month. And then China's supplier costs are beginning to fall. So that's like importing inflation or disinflation or deflation from our suppliers. Remember, most things are made in China, whether we like it or not. So let's look at that inventory. Inventories have massively spiked. The way you want to look at this is that when inventories spike to a really high level, that is just pulling future growth into today's growth, which means future growth is going to be lower, right? If you buy more iPhones today, you don't have to buy as many iPhones tomorrow, right? Think of it like this. If you need an iPhone, you go to the store and you buy it, you don't have to buy it on day 2 or day 3 or year 1 or year 2, right? You've pulled forward that demand. So pulling growth forward lowers future growth. Higher GDP today, but lower GDP tomorrow. The same holds true on the reverse. When inventories are drawn down, suppliers have to rebuild those inventories. If I sell out all my phones in stores, I got to buy all those phones from Apple. Well, what that does is it means lower growth today, but higher growth tomorrow. And so right now, inventories are really high. And that acts as a headwind on growth over the next 12 months. So remember, when we reallocated the portfolio in January, it's with a 12-month time frame. We're beginning to see those things come through. The other thing that we've seen is the yield curve, right? So most people look at the yield curve. We look at the future expectations of the yield curve. And what we see here is that it's actually gone negative. So when the 10-year yield or the 10-year interest rate minus the 2-year interest rate goes negative or flattens out, it means that expectations around future growth are beginning to fall. And what does that mean? That also tends to be a leading indicator for inflation and interest rates. So as growth drops off, that demand that pushes inflation higher begins to subside, and you start to see inflation subside with it. And then interest rates follow all of that. It's like gravity. So how does that impact how we invest as investors? Remember our framework. Inflation and growth peak out in 2022. You can go back to our January outlook. Both of those are now happening. What does that mean? Bond yields tend to top out when that happens, and growth comes down. When growth comes down, cyclical assets, so assets that are economically sensitive, tend to underperform, and secular growth assets, so in other words, companies or stocks that don't need 5, 6, 7% GDP growth to outperform or to grow their earnings 20%, tend to outperform. Why? Because I want to own companies that can actually grow 20% in a 2% growth environment. That's the key. And then secondly, what we know is that sentiment is god awful right now. I mean, I'm sure none of us are feeling hugely optimistic when we look at the way the market's been acting. But when we look at consumer sentiment right now, the Michigan consumer sentiment, that's not just Michigan, but all of the US, but it's the name of the survey, is back down toward March of 2009 levels. Back toward March of 2009 levels. We're nowhere near in terms of where we were back then. And also back to the bottom of the secular bear market in the late 70s. What you typically want to do is you want to actually invest when consumer sentiment gets under 60. Under 60 now, under 60 during the European debt crisis in 2011, under 60 in 08, and under 60 in the late 70s. It only happened 4 times. And each time it's been a very significant buying opportunity. So when consumer sentiment's less than 60, we want to buy stocks. And we see that the highest forward returns tend to occur historically when consumer sentiment is under 60. So our general rules, remember this, when everyone's fearful, stocks are oversold, that's our high conviction buy zone. When no one is fearful, everyone's happy and everyone's bullish, and stocks are overbought, that's when we want to be greedy, and that's when we want to sell. And remember, the Fed does care about stocks. We look at US household equity holdings as a percentage of GDP right here on the left. It's never been higher. So when stock prices do go down, it has an actual impact on consumption and growth because we see our account values, considering most are invested highly in equities. And we say, you know what, maybe I'll push that vacation off a month. Or, you know what, maybe we won't go out to dinner twice a week. Maybe we'll do it once a week. It has a precipitous effect. So the Fed does tend to cut rates once stocks fall below 10% off their peak. That's just been historically the rate. We see that initial rate cut through these red dots after these 10% drops in the market. That was when equities were a smaller share of GDP. They're now close to 18% of GDP versus about 10 years ago where they were 10% of GDP. So what's the bottom line message here, ladies and gentlemen? Growth and inflation are beginning to slow. Our 2022 framework is coming into gear, is coming into shape, and we expect investors to increasingly focus on companies that can grow in a low growth environment. Yes, the Federal Reserve raised interest rates this week, but they've really already done it 6 to 7 times. Just look at those mortgage rates. It's what they do after that really matters. So think of what will they do in January of 2023 and allocate assets based on that. It does appear that growth and inflation are slowing. That's good for secular growth assets, which is where we are trying to position client assets today. So that's what we got this week. If anyone has any questions or concerns, please feel free to reach out to your advisor or to us, and we'll be more than happy to answer those questions. Thank you again, and have an absolutely fantastic week.